It looks like everybody who's going to join us is, and anybody who wants to can still join us. We're going to have a recording of this. My name is Karl Frank, president of A&I Financial Services. It is such a pleasure to talk with you today and give you our third quarter 2022 investment and market commentary. We're calling it recent investment changes because we've made some, and not everything is spooky in October because we're optimistic. There are going to be four of us talking today. As you know, we're a team. Now, everybody who's on the Zoom call, thank you for your patience. We've made you invisible and we've made you muted. We still want you to ask questions. There will be Q&A at the end. If you'd like to ask those questions, click the green icon at the bottom of your screen, the chat icon, and type it in at any point in time. We'll take all your questions at the end of today's presentation. Communicating with you is very important to us. So we do want you to ask those questions, but you're going to be muted, you're going to be, and you're going to be invisible. You're only going to be able to see us. Now, if you haven't already, please subscribe to the YouTube channel where you'll see this recording and all the others. Make sure that you subscribe to our podcast, the Expert Network team. If you're not getting the weekly Periscope email, please talk to your financial planner or anybody here at the Client Care team. We'd be happy to make sure that you get that. There's a lot of exclusive content in the weekly Periscope email that you can't get anywhere else. Like us on Facebook, like us at LinkedIn, and follow us everywhere. We'd love for you to join us on all the different media. We try to provide something unique every few days all over. So we'd love to share that with you and make sure that you are informed with what we're doing in your investment portfolio. All right, well, without further ado, I'm going to introduce the team, and then I'm going to kick things off. So the first speaker that we have today is Virginia Wu. Virginia is a certified financial planner at A&I Financial Services. Virginia's worked in financial services and wealth management for a decade. She was previously based out of Raleigh, North Carolina, where she came to us last year in June, in the summer of 2021. She holds a certified financial planner designation, which she acquired after graduating from North Carolina State University with a bachelor's in international studies. Virginia holds the FINRA license 76365, as well as life, accident, and health insurance licenses. She's enjoying the active Colorado lifestyle by spending time with family, hiking, snowboarding, and skydiving. Yes, skydiving. Type in questions in the chat menu about that. Our second speaker will be Chad Harmon. Chad's a partner here at A&I Financial Services. Chad has helped clients build and preserve their wealth since 2004. Chad's held a BA in finance from the University of Colorado Boulder. He's been featured in 5280 magazine and Colorado Business, and in 2015, the Wall Street Journal highlighted him as one of the wealth managers you need to know. Chad holds FINRA license 7066, life, accident, and health. When not working, Chad loves spending time with his wife, Melissa, and three sons, Max, Carter, and Charlie. He enjoys the Colorado outdoors, doing things as golf, fly fishing, biking, and coaching youth sports. Our final speaker today is Judson Cass. Judson's the CFP AIF AAMS financial planner at A&I Financial Services. Now, Judd holds a certified financial planner designation. He has over 20 years of experience in the industry. In fact, Judd started his career in investments while he was in high school. He interned at the Chicago Board of Options Exchange, running tickets as a clerk. After graduating from high school, he went on to the University of Ohio, where he earned his BSBA in finance from the Fisher College of Business. Judson consistently studies investments and enjoys reading economic history. So ask all of your tough questions of Judd. Okay, without further ado, let's talk about today. Welcome to 2022. Holy cow, if you're not exhausted, you're not paying attention. I mean, you're in good company. If you just feel exhausted, think about all the things that are affecting us that are completely outside of our control. We just came out of a pandemic, and lo and behold, we go right into a war between Ukraine and Russia that threatens to possibly be worse. We've got the worst inflation that we've had in 50 years. And we've got the highest increase in interest rates that we've had in 50 years. And all of a sudden, with all of that going on, we've got an every 5-year run-of-the-mill standard average bear market in equities, but it feels so much worse than that, doesn't it? With all these things spinning out of control, it just sometimes feels exhausting. Well, let me tell you what we're going to do today. I'm going to talk about what we've already done. The three things that we've done. I'm going to talk about the 5 big drivers of investments this year. And then I'm going to hand it off to Virginia to put a little perspective on this. Virginia's going to hand it off to Chad to make it a little bit even more clear. And then Chad will hand it off to Judson, where Judson's going to talk about what things are real, and he's going to talk about something really sweet. So I think you're going to really enjoy this. Again, go ahead and ask your questions now or at any point in time, and then we will answer them at the end of today's seminar. So what are the 5 big things driving the market today? Oh my goodness. Let's just talk about what we believe and make it real for you. At our firm, we approach all decisions here from our core beliefs. And one of our core beliefs is that the right way to invest is to diversify by strategy. We never want to make so much money with any one investment decision that we're killed by it, or that we make a killing by that investment decision. So we're going to be diverse. We're going to put our money in, or spread our eggs into more than one basket. And that's served us well over time, and it's going to serve us well again here in the future. We use 2 different research partners at A&I Financial Services to help us make the investment decisions across different strategies. Athena Invest and IM Global Partners, IMGP, formerly known as Littman Gregory. Today, both of these investment research partners are short-term concerned. That hasn't happened since 2008. So we're in something big, right? This is it. All of these feelings that we're having are different than what we've had before. They're familiar, but the situation's slightly different. And there's 5 big factors that have us concerned. And the first of the 5 is inflation. Inflation rate today is too high. And in order to fight inflation, the Federal Reserve and central banks all around the world are raising interest rates. Inflation is not just a US phenomenon, it's a worldwide phenomenon, and inflation is a problem. That brings up the second big factor, which is interest rates. Interest rates are affecting our investments, they're affecting our portfolios, they're rising at a faster rate than they've risen again in decades. And the Federal Reserve is raising interest rates on purpose in order to fight inflation. And if you're interested in how that works, type it into the chat box. We'll be happy to talk about it at the end. I don't know which one of us is going to grab that one. It might be Judd again. He's easy. He reads this. He loves this. So those are the 2 first of the 5 factors that, we've got bad inflation. We're raising interest rates in order to fight it. And because of that, bonds are going down. And as interest rates go up, bond prices go down. That hurts our investment portfolios if you have money in bonds. The good news to this is that we're in a world where you can finally get some income from your fixed income portfolio. Just a year ago, you're looking at 0% or 2%. Today, interest rates, generally speaking, start at 4% and get bigger. They get better after that. What that means, just think about it for real. If you need $5,000 of income, today, if your yield is twice what it was last year, you only need half as many dollars to put to work in order to provide the same amount of income. So there's always something good going on. It's looking forward that looks better, but the past 10 months have been really rough for the 2 things I just talked about. The third thing, not to be outdone by bonds decline this year, are equities. We are in an every 5-year run-of-the-mill average, typical bear market in equities. It's all these other factors that are making it seem so much worse than what's happened before. What happens in the bear market is that we feel like it's unique, and this one's big. It's definitely a lot of factors going on. The 4th big factor, not to be outdone by that, our research partners at IMGP are predicting a recession. And so the recession word is all over the place, and you'll hear it again and again. And that's driving our feelings. It's driving the investment markets. It's driving what I'm talking about here in a few minutes about what the changes are that we've already made. And the recession is also, from the 5th factor, a cause and a symptom. The 5th factor is unemployment. Unemployment is great. In fact, it's really good news. We've got the lowest unemployment that we've had by some measures in history. By any measure, it's very, very low. And the jobs available by some measures are the most jobs we've ever had available. And by other measures, they're still really high. So how can we possibly be in a recession with really low unemployment when things are so good, when people who are looking for work are finding work, when people who are at work can find even higher income somewhere else? Well, that's the driver. And if you have any experience working with an economist, you know that they always have 2 hands. On the one hand, unemployment is good, but on the other hand, it's not so good. And the Federal Reserve, being a whole bunch of economists, looks at unemployment and say, well, unemployment being so low means inflation is going to come, wages are going to be higher, we're going to have more and more inflation, we got to keep fighting inflation, and so we're going to keep raising interest rates. And so there you go. On the one hand and on the other hand, I feel like I feel like President Truman, who said he always wanted just a one-handed economist. I just want the good news. Don't give me the bad news, right? Yeah. So how do you know when you're at the rock bottom? Well, we don't think we're there yet. maybe, perhaps, when you touch Dwayne Johnson's backside, you hit rock bottom. All right, so we've already had 5 crazy things driving our portfolios. What have we done about it? Well, sometimes when you, our clients, look at our portfolios, you think, gosh, why don't we just all go to cash? Can't we all just go to cash? If your research partners are finally in agreement, and they almost never are, and everybody thinks things for the short term are going to be bad, can't we just ride it out in cash? And the answer to that is a clear no. No, one of our core investment beliefs is that the right way to invest is to diversify by strategy. And so if we put all of our investment nest eggs into the go to cash strategy, we're going to make a really big mistake. Remember, we never want to put so much money into any one investment decision that we either make a killing or are killed by it. The right way to invest is to diversify. That having been said, the first change that we made for many of our client portfolios is that you went to cash. In Athena market rotation portfolio, you have had your investments already moved into a very low risk cash investment for months. And that's one of the strategies that we employ. And so if you have money in Athena market rotation, you can rest assured that they have already taken action in this bear market, in this economy, in this situation that seems so uncertain. So that's the first big change that we want you to know about. Even though it might still say Athena market rotation, the investments inside of there have made a move. The second big change is in the foundation income sleeves. Now, not everybody on this call will have money in all 3 of these or any of these investments that I'm talking about. Some of you will have money in all of them. But in the foundation income sleeve, we view this as the foundation of our clients' retirement income. These are bonds. And we made the decision to focus in on the 3 fixed income managers with whom we have the greatest confidence. And like I was telling you earlier, we are really excited about the future. The future for fixed income looks very good. And so we're making a decision to put our eggs with a few less baskets on the men and women who we believe are going to position us for the best future success in the foundation income portfolios. The third big change we made was in the international equities sleeve. So if you have money in our international equities sleeve, you might want to know that we sold one of your holdings. One of these holdings we've held for over 10 years, maybe close to 20. We've held it for a very long time. But we've made a decision to move into a different investment manager. Now, we've been researching it for years. And this summer in August, I flew out to London to visit these people. Now, believe me, before I fly out and visit one of these money managers in person to do in-person due diligence on site, I like them, right? Well, I'm not going to make the decision, especially on such a long plane flight in the middle of the worst heat wave that London's ever had, in a town that's famous for not having air conditioning. Am I going to make that trip? But I did, and I confirmed the research from our team. And I would love to share with you, your financial planner would love to share with you the details about who that is, why we like them, what our process is. But we're so confident in that decision, we think that we'll hold them for another 10 years. We think that they'll be a positive contributor above and beyond what we had in the portfolio. We're very excited about that. Now, sometimes, those are 3 changes that we've made, right? Sometimes the decisions that we make are the most important decisions to make are to not make a change. And one of the biggest decisions that we didn't make this year was to rebalance. Now, if you recall back in 2020 and you're paying attention to, and your financial planner is talking to you, for many of our clients in our standard portfolios, like the ones I was just talking about, we hit the rebalance button shortly after the exact nadir, the rock bottom of the 2020 crash. And that COVID crash didn't last very long. And we believe that that rebalance decision that we made 2 years ago helped us, because we're invested just like you, and you recover a little faster. So we think that was a really good decision. But again, we're not making that decision right now. And a large part of that is due to the research that we're talking about, that we might not quite yet be there, but we don't want to place our eggs in any one basket. And then the fifth thing that I want to talk about from our investment standpoint is that you might already, inside of some of the holdings, when you look at things and you think, oh, it's just buy and hold, there are a lot of changes being made. And some of those investments holdings that you have are in the sleeve we call SIMBA, Secular Bear Market Allocation. And if you have money invested in a sleeve called SBMA, then you might notice that those investments are positive. So ask your financial planner about those holdings. Ask a financial planner, about Simba, ask them what's going on and what's right for you. You might want to learn a little bit more, and you might feel a whole lot more comforted. So I'm going to hand it off to Virginia, but before I do, there's one more thing that I want to make sure that we talk about, that we are in a recession, but recessions are usually mild. So take a look at the slide behind me, and you'll see that every recession that we've had since World War II is on the screen. And the length of that recession is the big red bar in months. The blue bar shows the depth of the recession in percentages, with the largest percentage decline happening in 2020, and it's about a 9% decline in the GDP. That's the worst that it's ever been. Recessions are usually mild. It was also the shortest recession that we've ever had. It lasted in a blink of an eye. In fact, if you didn't know that it didn't happen, it's probably because you were wearing a mask and your glasses were fogged up. Like the recession from 2020 was the worst that we've had in depth, but the best that we've had in duration. Now, just before that was almost the exact opposite. That's the 2008 recession. That's the one you might remember most because it hurt bad. The great financial crisis was a situation that many of us are still holding inside of us. And we look at this and we think, oh my goodness, it could be that again. But look at the duration here, and it's hard to see on this slide, but even the longest that we've ever had was an 18-month-long recession. We are already 10 months into this bear market. Think about that. The end of this bear market crash could be sooner than you think. It might already be upon us. And when it comes back, when things are good, they could be better faster than you ever thought possible. And this is common. Every bear market feels unique. Even though it feels so much worse this time with all the other factors that I just mentioned, this looks, from all of our research, to be just another every 5-year run-of-the-mill typical bear market. And we're still not sure we're done. So we're going to remain a little bit cautious, but I'm going to give you all these reasons for optimism, some of which I've hinted at already, and hand it off to Virginia. Virginia, here you go.
Thank you so much. Like Karl mentioned, my name is Virginia Wu, and I'm going to stick on this exact same topic of the history of the market and looking at recessions. So this is a very complicated chart, but I'm going to make it really straightforward and easy. Really, we're just going to be looking at the shapes here. Let's not get bogged down into the details. But the first thing you'll notice when you look at this chart is this blue line that's coming up from the bottom left going to the top right. And that's the S&P 500. Now, this chart starts back in 1960 and goes through today, but this history is something that we can go back further if we wanted to. The second thing that you'll see are these bright orange and gray lines coming down from the middle. Now, those represent the intra-year increases and declines in the market, or put simply, the highs and lows that we see daily throughout the year. You'll notice a couple of things when we look at this versus the market as the whole. And the first thing that you'll really notice is that they're a lot more dramatic in the short term than what we see on a year-to-year basis within our market returns. The second thing that you'll notice is that they're really clustered together. And what I mean by that is that really every time we see one of these big orange spikes that we like to see with a huge market increase, that's going to be paired either in the same year or shortly after one of these gray declines. And you can see that this is an example here. It's from the 80s where we see the immediate decline. And then the next year we get the big spike up. More recently, like Karl was talking about, we've got the 2008 drop, which went for a little bit longer, you can see, but also has a really nice orange side. And even today, kind of coming off the end of the chart over here, we've got a big gray down and we've got some orange up. So what does this mean? Well, ultimately, it means that we need to have a plan to get through our gray, rainy days in order to be able to take advantage of our sunny orange upside. So if we can't stomach that more scary gray day, then we're never really going to get the positive side of it. So with that, there's a theory in psychology called loss aversion. And what that really means is that when you look at your statements and you see a negative there at the bottom, that's going to hurt disproportionately more than you would feel happy if you saw that same dollar amount going up. So another way to think about it is that this much loss gives you the same emotional response as this much gain. So you feel the pain more than you feel the happiness. There's a really good example of this that we can look at in terms of how it actually impacts your portfolio by looking at a study that was done in directly looking at investors. So there was a group of investors that was studied. They all had the same stated risk tolerance. One half was shown a set of market returns for stocks and for bonds on a monthly basis. The other half was shown that same data just on a yearly basis. So again, same risk profile, same net data, just monthly versus yearly. And both of those groups were asked to create a portfolio. And this is where we see quite a lot of difference. So in the first group that saw the data on a monthly basis, they decided to put 59% of the portfolio in bonds and 41% in stock. Now, we know, generally speaking, stocks tend to be the more volatile of the two. And so they were really trying to get more stable here. The group that looked at the data on an annual basis every year only put 30% of the portfolio in bonds and put an entire 70% of the portfolio in stock. So pretty big difference there. Now, ultimately, which portfolio is right? Who knows? This was an experiment. We don't know any of these investors personally, but what we do know is that they did have the same stated risk tolerance. And this group over here who looked at it annually ended up making a lot more. Now, is ignorance bliss? What I really want you to be able to take away and take action on with this is to make sure that you have a plan for those scary, stormy gray days when the market is dropping, when things feel crazy. If we look at it yearly, if it's checking in regularly, whatever it is that works for you, we want you to be closer to this side of things. So make sure that you're working with your advisor. Make sure that you have a plan that you can feel confident in. That way, if you check your account yearly, monthly, every single day, you know that you have an umbrella to protect you from all of that rain, all those gray days, so we can enjoy the bright sunshine orange. I'm going to hand it over to Chad, who's going to keep going with this idea.
Thanks, Virginia. All right, for my first slide today, I'm going to put on my therapist hat and talk about our feelings. The chart behind me looks very much like other charts you've seen this afternoon. This, however, does not reflect movement of the stock market. What the chart behind me is referring to is consumer sentiment. Consumer sentiment is a reflection of how we investors feel about our personal finances and the state of the economy. One thing that you'll see is that recently, after second quarter this year, consumer sentiment hit its lowest level since the 1950s. That means that the investing community today feels worse about the state of the economy than any point during your lifetime. I want to let that sink in for a little bit. We don't feel warm and fuzzy. We're terrified as investors. And the question we ask ourselves is now a time to just take our chips off the table and bury it under our mattress or go buy gold or do any of these things you hear a lot of your friends and family talking about these days? Or is this a time that we should be more open to the idea of taking on risk? The only other times that we've had consumer sentiment reach the low levels that we see today were in the beginning of 2009. Okay, and the beginning of the 1980s. And I want to touch on 2009 and what was going on in the world at that time. Okay, we were coming off the global financial market meltdown. Okay, we had the U.S. auto industry in shambles. Okay, Judson's going to get up and talk about candy bars here. And I remember back in 2009, you could buy Ford stock for less than the price of a Snicker bar. To put some context to that, okay? We had Lehman Brothers went out of business. We had geopolitical risks all over the world. We had a 40 to 50% drop in the equity markets. And at that time, there was no silver lining in sight. Okay. And many people decided to pull out, and that proved catastrophic financially for them moving forward because they missed one of the greatest opportunities to build wealth of their lifetime. In fact, if you would have taken $1 and invested it the day that sentiment hit those low levels, over the next decade, you would end up with almost 4 times as much money as you started with, a remarkable uptick in the markets. In 1980, okay, we had other major changes going on in the world. Okay, again, geopolitical risks were prevalent. We were worried about inflation. We had a stock market that had been down 3 of the last 5 years, and we were grasping for straws to try to find something positive. In fact, we were at the very beginning of a recession, something many of you may be worried about today. And if you had the stomach to put $1 in the market at that time, even though we hit a recession in 1981 and 1982, you still would have been able to grow your portfolio to almost 3 times the size you started with. So it's important for us to understand that when people are fearful, it may be time for us to get greedy. Okay. When people are greedy, that may be the time we need to be fearful. And that was never more present than the time consumer sentiment was at an all-time high. This was the late 90s. Okay. The dot-com bubble was in full force, and your cab drivers giving you stock picks, and we're all going to become millionaires overnight. So people were refinancing their house and taking massive amounts of leverage to put into the markets because you couldn't lose. Right. And they learned a very hard lesson moving forward. So it's not always a reflection of how we're feeling and what the market's going to do moving forward. Sometimes when we're feeling at our lowest, those can be the areas of greatest opportunity for us. Now, I know there's a lot to look at on the chart behind me. This is a reflection of 10 leading indicators of the economy. This is our attempt to look through the windshield of the car rather than the rear view mirror. And every column you see behind me represents a year, okay? Starting when we were recovering from the 2008 crisis, moving over to the recent market performance. These last 3 columns represent the 3 quarters of 2022. And the premise of this slide is to show you that the world is not all on fire. The economy is not all doom and gloom today. That many of these leading indicators are actually showing very, very positive news. Although we do see some red at the top, these are indicators such as return of the stock market, consumer sentiment, which we just talked on, and what's going on with interest rates. Down towards the bottom, I feel a lot better to see that, hey, U.S. businesses are loading up on their inventories. Many of these companies have record sales. That's a good thing for stock investors. Okay? Housing starts are nearly 3 times the level they were during the bull run of the real estate market. Okay, and business permits are up. These are all very good signs of a little bit of foundation or support in the underlying economy. The last slide I'm going to touch on has to do with the US dollar. Karl hinted a little bit about inflation. We've all felt the pain as we go to the gas pump. I have 3 little boys eating me out of house and home, and I thought I had a heart attack last time I checked out at King Soopers and saw my bill. So this is a real thing affecting everybody on the call today. And inflation since the beginning of the pandemic is at near record levels. Okay, we're more than double the historic average. That's represented by the red line on the screen. Now, when inflation is high, we feel that our dollar is declining in value, that our dollar cannot buy the same goods and services tomorrow as it can today. But the green line on this chart shows you that the dollar is actually experiencing a little bit of a different trend than we might expect. The dollar is appreciating in value, not depreciating. Now, the dollar has not gone up as fast as the rate of inflation, so our purchasing power has declined over the last 2 years. But when we compare the dollar versus other options worldwide, like the yen, the won, the pound sterling, okay, the euro, the dollar is actually appreciating at record levels. That means it's cheaper for U.S. businesses to import goods, and there's a lot of opportunity that can create. Now, what will the future have in store? Only time will tell, but it is important to know that a lot of our fears on inflation and the dollar devaluing have actually been inaccurate so far in 2022. I'm going to hand things over to Judd to wrap things up, and then we'll get into our Q&A at the end.
Hi, everybody. Okay, so a couple of things. This is valuations, okay? So this is, I don't know if you guys can read this, cyclically adjusted price to earnings ratio. I know that's a lot of gobbledygook for financial advisors to talk about in meetings, but what it really means is how much bang for your buck are you really getting? That's really important to know. So you see way up here on the top here, that high is at 38, almost 40. So that's the high that we experienced just at the beginning or the end of 2021. And we've come back down to 28. That's just above our long-term average, which is about 26. So really, we're just getting back to the normal averages here. So really, this is nothing to be afraid of. This is normal stuff. Well, I look like I'm huge on the screen. It's funny that I'm going to be talking about shrinkflation next. So what is shrinkflation? Shrinkflation is really just, it's defined by Merriam-Webster as the practice of reducing a product's amount or volume per unit while continuing to offer it at the same price. So you pay the same amount and you get a little bit less. And because we got Halloween right around the corner, we're going to talk about candy bars. Because who doesn't like candy bars in October, right? Well, you'll notice that in the screen behind me, you'll see all those candy bars are getting smaller. Now, this was done by the BBC years ago, and it ended in 2018. So you'll notice that a lot of these candy bars have weird names, grams. I really want to try this, or is it the Yorkie bar? That looks delicious. Raisin and biscuit. Sounds delicious. Now, we don't get those, but the concept is exactly the same. So what are companies doing now? They have this, listen, companies live in the same world we do. Gas costs more, transportation costs are going up, commodity prices are going up. So they have to respond in the same way that you and I do. So what are their choices? They have the choice of raising prices. Well, there's a problem with that. You can imagine for something that doesn't, or you can't shrink it like a gallon of gas, my goodness, that shows up in the news immediately and people are protesting and angry, and you'll see the gas station in the background and how much they're charging. People are angry immediately. Well, these companies don't want to get involved with that. So that's right out. You don't want to do that. Your option number two is to change your suppliers. Well, that could change the flavor of any of these candy bars here. That's kind of a big deal. Do you guys remember Coca-Cola back in the 80s? They went with something called New Coke, and people were actually marching in the streets. They had World War II veterans marching down the street because they were so angry that they changed the flavor of Coke. Candy bars don't want to do that. They don't want people to protest. Brand loyalty is huge to them. So the last option they have available to them is something called shrinkflation. So they reduce the size of their candy bars. Now, shrinkflation happens everywhere. It'll happen in the cars you buy. When you go to the dealership, you're going to have a lot fewer options that are standard. Everything's going to be an upgrade. When you go to a hotel, you're not going to get towels every day. That was kind of the reason to go to a hotel, was to get those free towels every day, but they're not offering that. Airplanes, you'll notice that you're not getting your free meal anymore. That's been around for a long time, but now we're seeing, do you even want bags? I got an $88 flight, but if I wanted to take luggage, I had to pay an extra $200. So that's all part of shrinkflation. Now, companies don't get away for free. When you're dealing with candy bars, you have to go and change your entire manufacturing process. All your machines are set to an exact amount, and they have to change all that. So they can't just do this overnight. They also have to work with their retail partners. How are they going to sell this to their clients? Is that going to upset people when you stop by King Soopers or Safeway? And very often, yes, it is. So they have to all be part of the process. So what do you do? This is no fun. Nobody likes to see their product shrinking. There are a couple of things you can do to be aware of that. First of all, you just want to be aware that this is actually happening, and it's global in nature. So this is not just going to happen at the grocery store. What you can do is you can watch for packaging changes. That's the easiest place where you can spot these changes, is at the grocery store. Are you looking at the grams in your package? Are you looking at your Doritos? They went from 10 3/4 ounces to 10 1/4 ounces. You might not notice immediately, but you're going to get a lot fewer chips in your bag. Cereal's notorious for this. They'll advertise a family pack. Well, that family just keeps getting smaller. It used to be 21 ounces. Now it's 18. Well, that's a couple bowls of cereal. Paper towels. There's fewer rolls in the paper towel roll. That's a big deal. So what you can do is you can watch out for it. Just be aware of it. Watch those net weights. Store brands are typically the last place to move when you talk about shrinkflation. So Costco has Kirkland, Sam's Club has, I don't remember, I forget what Sam's Club says, but everybody has a house brand that they sell. So those are typically the last ones that you can, that will see that price inflation or that shrinkflation, so you can move there. You can compare prices, but here's your CFP talking, make a plan. Go in there in your grocery store and you have to know exactly what you need to get to make the recipes that you need to make. So have that plan, stick to it. Again, CFP talking here. So that's how you get through shrinkflation. So a lot of bad news. Here's some good news. These are publicly traded companies, guys. So there's a lot of investing that you can do. So if you can't beat them, join them. Go sell those candy bars for more, and you can participate in that. And so, historically, equities are a great way to fight inflation. It may not feel good when you go to the grocery store, but it sure will feel good when you come talk to us, because we're helping to fight inflation that way. So that might help you in the long run. So I'm going to turn it back over to Karl, and we're going to do some questions and answers. Great to see you guys.
Very good, Judd, Virginia. Chad, great job. Thank you so much. And thank you for joining us today. We're so excited to have you a part of our extended family. I want to remind you about our final event of the year. We're having our holiday party back again. It'll be twice as good as it's ever been in the past, because it's been 2 years since we've done this. We used to do it every year. It's December 2nd. It starts at 4 p.m. It goes to whenever it ends. Please come by the office. We'll have big news at that day. You want to be the first to know, and tell all your friends, because it's going to be so exciting. But you've got to come to find out. You want to find the first one out of all your friends to know what the big news is on December 2nd, come to our holiday party. All right, before I let you go, please make sure that you talk to your financial planner and that you learn more about us. Make sure that you find us on Facebook and like us, find us on LinkedIn and like us, subscribe to our YouTube channel where you'll see this video. You can share this video and all the other commentary that you have with your friends. We have a blog on the website. You can read these commentaries at any point in time. We have the Expert Network Team podcast. You can subscribe to that on your phone, your computer, anywhere you like. We're having some really interesting conversations this year as I talk to a CPA, an estate attorney, insurance experts, and all sorts of people about different topics on the podcast. You can get that anytime you want and hear from us anytime you want. But most importantly, talk to your financial planner. We've got the weekly Periscope where you'll get the full 19-page commentary about this presentation. You can read more and ask more questions of your financial planner then.